Hey everybody, welcome back. In this video, I want to introduce you to a broader perspective on our economy, and that is to introduce you to an even bigger aggregate measure of economic productivity called the gross output. So back in 2005, federal economic officials started calculating the gross output, which is an attempt to measure all sales in the economy for all goods made, even ones in earlier stages of production. So the gross domestic product, which is how we usually calculate and realize economic growth, is a measure of the sales of the final consumer goods. So goods that are bought at Walmart is how I look at it. The final sale, whatever we're buying off Amazon, in general perspective, it is all purchases that have been made, the final sales of all goods to their customers. So the consumers, the government, everything is inputted into that. That being said, your gross output is a measure of not just the GDP, but it's also what businesses sell to each other in goods to help produce that final good. So what can this tell us? Well, one of the things that it can teach us is that it can teach us that there are two sides to the economy, and I think that gives you a better roundabout look on how our economy functions. You've got your red line here, which is your consumer base, your consumer economy, but the blue line here is what I call your producer economy, okay? So this is the economic growth of our producer industries. And how do we get this? Well, we take the gross output, right, which is a measure of total sales of all goods, both producer and consumer, and we subtract out the gross domestic product. So when we do that, we get a look at the way that our producer economy functions, okay? Because all producer goods have to be made in order to create that final consumer good. If your production side of the economy starts to fail, then your consumer side of the economy will fall with it in time, okay? So the producer side is much more sensitive to economic cycles than the consumer side because it's usually the first to start crumbling since it's your producer base, okay? Ergo, on a flip side of this is that if your producer side of the economy is growing, even if your consumer side is not yet expanding at that rate, it will soon because we are producing more goods, which will drop the prices of available goods to market, which will then allow more to be sold at lower prices. That enhances economic growth over time. Now, all that being said, it stands to reason that if we're measuring the producer side of the economy, right, and we combine it with the consumer side of the economy, that gives us a measure of total economic growth. But how do we control for prices then? In the GDP numbers, we control it by taking GDP and dividing it against the consumer price index, okay? And we take that change over time. So when we say that the economy grew by 6%, we're controlling for the change in the consumer price index. So in reality, if the consumer prices increased by 3% in a quarter, but your nominal GDP on the numbers grew by 9%, then you subtract 9 from 3 and you get a real GDP growth of about 6%. But how do we do that for the entire economy? Because your producer side does not operate by consumer prices. Well, your producer side operates by the producer price index. That's what it stands to reason. So if we take the gross output and we take the producer side of the gross output and control for producer prices, and we take the consumer side of gross output, which is your gross domestic product, and control for consumer prices, and then add the two sides together, we get a measure of real economic growth. And so this is what I'm tracking and showing you right here, is how our real economy is functioning, okay? Now, that being said, you can see the huge drop in economic growth in 2008, and it is much more pronounced than real GDP's drop to show you just how badly hit our economy was. One of the interesting thing is that on the aggregate, our economy started to dip a little bit in 2011. Not bad, and Ben Bernanke actually stepped in with QE2 at this time and started injecting more monetary stimulus after the initial rounds of QE1. I think he saw something in the aggregate numbers, maybe not what I'm looking at right now, that kind of showed that there was going to be a dip in economic growth that prompted him to do QE2. Anyway, you can see here the huge drop in economic growth in Q2 2020, which was brought on by the government shutdowns over the COVID pandemic. It also gives you a broader perspective of, and in my opinion, a better perspective of our recovery. In truth, while real GDP numbers have already turned positive year over year, these are year over year percentage trends, by the way, your aggregate your economy, your real gross output is how I call it, is really just now in Q1 2021 just turning positive. And unfortunately, Q2 numbers for gross output will not come out until the end of September because it tends to lag behind your GDP by 2 months, because to calculate gross output, we take the GDP by industry and aggregate that. Okay? So I won't be able to get Q2 numbers until the end of September. So then, with this being said, why am I creating this video and showing you all of this? Well, it's because of this right here. This blue line is your producer side of the economy. Your red line is your consumer side of the economy. The blue line is controlled by producer prices. Your red line is controlled by consumer prices. And remember what I said, when your producer side of the economy starts to fail, your consumer side will come along with it. So if you're producing less goods, then it stands to reason you will consume less goods. They will become more expensive. You'll sell less, okay? So that being said, what is this a concern? Well, in Q1 2021, and this may not mean much, but we could be onto something. Look at what happened to your producer side of the economy. It actually dropped in numbers. Now it's basically flat, but it dropped. And what was causing this drop? Well, that was the spike that we were seeing in producer prices. Okay? So what I did was chart this out and showing you here through these two lines here, comparing and projecting out from where these left off in the next 2 years. Okay, so I'm taking your producer output and comparing it to real GDP. So your real GDP is in orange, your producer output is in blue, and then what I'm doing is factoring in the producer price index and the consumer price index as normal. Okay, so I'm controlling for prices here. And what I want you to take note here is the producer prices have been escalating. They've been going up very high. And as a matter of fact, based off of just the way they've been trending, if they continue to trend as they have been toward the end of the year, we're going to see an aggregate producer price inflation of around 23 to 25%, maybe somewhere in between around 23.8, 24%, which is going to be enormous. This is an enormous CPI. And as I've mentioned in an earlier video, and I'll post a link to that, it tends to be that when your producer price inflation is spiking, the CPI will increase by 1/3 of that. So sure enough, I've got the CPI going up by 7 to 8% by the end of the year, because your producer price inflation is looking to go up by 24% at the end of the year. And that's how I'm getting and projecting out these price indices, okay? And then what I'm doing after this to control for 2022 is taking the broad aggregate money supply index here, okay? So I'm taking a look at the average annual CPI that is going to grow from here on out, right? And overlaying that here and projecting that out and showing you what real GDP is going to be. and then doing the same thing with the PPI by taking that 4.4%, just multiplying it by 3, because once again, when your producer price inflation is going up, the CPI tends to be about 1/3 of that when it's spiking. So this is just a rough guesstimate of how things are playing out, and then I'm just charting out the growth of the gross output and gross domestic product and your producer output based off of historical trends ever since we've come out of COVID. One of the things that I've noted here, though, is that once we take into all those calculations, do all that numbers, your producer output drops. It plummets, much like it did in 2008. But unlike 2008, which was caused by the bursting of a credit bubble, so there were debt defaults that were spiking, there were businesses that were unable to pay back debts because of lagging sales and decreased earnings, combined with higher producer prices that spiked at that time, mostly from rising oil prices as well as some kinds of foods and other commodities. We are seeing a huge spike in producer price inflation, and despite a bump up of what I expect a bump up in Q2 for producer output as the economy has reopened in the second quarter, similar to what we saw in GDP, from that point forward, we're looking at a plummet, just this enormous drop in producer output. And the last time this happened, it dropped the CPI and the GDP, real GDP, and turned it negative, and we put ourselves into a recession. But if you noticed here, although it is pointing to a weakening of GDP that is playing out here, it does not seem to push it all the way into a recession, even when controlling for a slowing GDP growth in 2022 as fiscal stimulus measures are put to an end. Okay? So then, but it's still pointing to the fact that GDP could weaken. The major concern here is that this assumes that consumer price inflation calms down. Right now, we're at 5.3% price inflation. And based off of my projections here, based off final demand, we're looking to see a CPI of jumping up to 5.7% year over year. I'm assuming that next year your consumer price inflation calms down a bit, back down to 4.4, after it spikes up to this 7 or 8%. But what were to happen if it doesn't? What were to happen if the CPI were to increase at the same rate that it was increasing in 2021? That's the interesting thing. And when you control for that and factor that in, well, my friends, that's telling us that we're looking at a recession in 2022. We're looking at the economy actually dropping and turning negative in 2022, which is basically purely from inflation. So whereas before I was concerned that rising inflation would create rising interest rates, and those rising interest rates would increase debt cost, which would then result in a drop in GDP growth and a loss of business sales, which would cause a rise in unemployment and a complete collapse of the economy. What I'm seeing here is a possibility that if inflation stays where it is, right? If inflation stays where it is, we are going to be in for a real rough ride in 2022 as the economy is essentially forced into recession, okay? It's forced into recession from rising price inflation. Now, it is possible, and again here, I'm not saying that that's going to take place. It is possible that what we may just get is just sluggish economic growth, and I think that's the more likely outcome. But if the economy is forced into recession, or even with a sluggish economic growth, real GDP numbers, I think that this would be a case to be made once again that we're looking for bearish times in the stock market. We're not looking for a real recovery in stock prices. Stocks are either going to stagnate or going to fall into a bear market. Honestly, I'm seeing this as a bear market right now, and with these price inflationary trends going on, as well as with a diminishment in producer output, unless if there is a reversal on the producer price index, unless if those producer prices start to come down, and they very well may, they may very well reverse, we could see the economy be dragged down into recession in 2022. Again, this will be another bullish case for gold and silver and a bearish case for stocks. But it's definitely something to ponder on. Before, I wasn't really concerned that the economy would completely fall apart until 2024 or so, 2024, 2025. But now looking at this is definitely making me really concerned about our economic future right now, especially in the short term. For these rising inflationary trends and diminishment of real GDP could then prompt the next credit bubble burst. As real GDP results in real losses in economic growth, it also results in real losses in sales, which means a diminishment in revenue, which means less money available to pay back debts. You have to borrow more money just to continue and maintain operations to float, which, you know, interest rates are ultra low, so that can happen. But in essence here, that can only go on so long before essentially it all comes grinding to a halt. When debt defaults start to pile up, when banks become unwilling to make the next loan, and the losses start to materialize. And that can happen sooner now than I think before because of these inflationary trends. So I leave that with you to chew on and think about and wrestle with, and what you may think as you make your own decisions now on what to do with your own future. But in this, I have to, give you guys the yellow alert, so to say. It's not a red alert. It's not like this is going to happen, but it's a yellow alert that we could be in for some very, very weak economic growth due to rising inflation both on the producer and the consumer side in the next couple of years. Thank you guys for watching this video. If you like my content, make sure you like the video, show me some support, subscribe to my channel, hit that notification bell so that way you get updates for my future vids. I'll probably create another video tomorrow that will go over another economic trend that I have been noticing lately. The big thing to look out for, though, is in 2 weeks we're going to get those inflation numbers for for July. That's going to come out in mid-August for both the consumer price index and the producer price index. I think that's going to be a real telling sign on whether we're going to be going through a real pandemic recovery or whether we're going to go through an inflationary breakdown. So stay tuned for that, and just keep your eyes open for what's going on. Make sure you leave a comment into the description below, just in the vid below. Let me know what you guys think about all this. Am I jumping at shadows here, or is could there be something to this trend that I've been noticing? Thank you guys, and until next time, I'll see you then.